Alright guys, if you're not mastering support and resistance levels, you're essentially trading blindfolded. Have you ever jumped into a trade thinking it's a sure thing, only to watch the price hit an invisible wall and reverse? Or maybe you've seen a stock tanking, sold in a panic, and then bam, it bounces right back up from a level you just didn't see? It's frustrating, I know. But what if I told you there's a way to decode these invisible levels? What if you could anticipate where prices are likely to stall, reverse, or break out with a much higher degree of accuracy? That's exactly what we're diving into today. I'm going to show you, step by step, how to identify and use support and resistance levels, the absolute bedrock of technical analysis. This isn't some get-rich-quick gimmick. This is a foundational skill that will fundamentally change how you look at charts and make trading decisions. We're talking about the tools that can help you improve your entry points, set smarter stop losses, and identify more profitable take-profit targets. So, grab a coffee, get comfortable, because by the end of this video, you're going to have a crystal clear understanding of not just one but 5 different types of support and resistance. Let's get into it. Alright, let's kick things off with the absolute foundation support levels. Think of a support level like a trampoline for stock prices. When a price is falling, it often hits this invisible trampoline and bounces right back up. It's a price point or a price zone where the demand for a stock is strong enough to overcome the selling pressure. This buying interest effectively supports the price and prevents it from falling further. It's like a safety net that buyers believe is a good value area, so they step in and start scooping up shares. Now, why does this happen? It's all about market psychology and past behavior. If a stock previously bounced off a certain price level, traders remember that. They see it as a historical bargain point. So when the price approaches that level again, a whole bunch of buyers are thinking, hey, last time it hit $50, it went up to $60. This is my chance to get in cheap. This collective buying action creates that floor, that support. Identifying these support levels is actually pretty straightforward, but it requires a bit of chart detective work. You're looking for previous swing lows on a price chart. These are the points where the price dipped and then reversed upwards. The more times a price has touched a certain level and bounced off it, the stronger that support level is considered to be. Imagine drawing a horizontal line connecting these low points. If you see 2, 3, or even more bounces from the same general area, bingo, you've likely found a significant support zone. So, why should you care about support levels? Well, for starters, they can present fantastic buying opportunities. If you see a stock approaching a well-established support level and other indicators align, it might be a signal that the downward move is losing steam and a reversal could be on the horizon. It's about buying when others are fearful, but doing so at a calculated point where the odds might be shifting in your favor. But here's a crucial tip. Never assume a support level will hold indefinitely. While strong support levels can provide great bounce opportunities, they can also break. And when they do break, it can be a very significant event. This is why risk management is so important, and why you always need a plan for when support doesn't hold up. Alright, let's kick things off with the absolute foundation support levels. Think of a support level like a trampoline for stock prices. When a price is falling, it often hits this invisible trampoline and bounces right back up. It's a price point or a price zone where the demand for a stock is strong enough to overcome the selling pressure. This buying interest effectively supports the price and prevents it from falling further. It's like a safety net that buyers believe is a good value area, so they step in and start scooping up shares. Now, why does this happen? It's all about market psychology and past behavior. If a stock previously bounced off a certain price level, traders remember that. They see it as a historical bargain point, so when the price approaches that level again, a whole bunch of buyers are thinking, hey, last time it hit $50, it went up to $60. This is my chance to get in cheap. This collective buying action creates that floor, that support. Identifying these support levels is actually pretty straightforward, but it requires a bit of chart detective work. You're looking for previous swing lows on a price chart. Okay, so we've talked about the floor, the trampoline support levels. Now let's talk about the ceiling resistance levels. Resistance is where selling pressure overcomes buying pressure, preventing the price from rising further. Think of it like trying to jump and hitting your head on a low ceiling. When a stock rallies up to a certain price and then sells off, traders take note of that level. If it happens multiple times, that price area becomes a known barrier. Sellers might place their sell orders there, thinking, this is where it topped out last time. Short sellers might see this as an opportune level to initiate their short positions. However, strong buying pressure can break through even the toughest resistance. When a stock breaks out above a key resistance level, it's often a very bullish sign. That old ceiling, once broken, can then transform into a new floor, a new support level. Alright, let's dive into something fascinating: psychological levels. These are price levels that aren't necessarily based on previous swing highs or lows but rather on human psychology. We're talking about those nice, clean, round numbers. Think $10, $20, $50, $100, $500, $1,000, and so on. It might sound a bit woo-woo, but trust me, these levels can act as incredibly powerful, albeit informal, support and resistance points in the market. Why? Because we humans are wired to pay attention to them. Think about it in your own life. When you set a goal, you often aim for a round number, right? I want to save $10,000 or I want to lose 20 pounds. It's just easier for our brains to process and remember these figures. Traders and investors are no different. Many will place their buy orders, sell orders, stop-loss orders, or take profit targets at or near these big round numbers. This collective focus can create a self-fulfilling prophecy where these levels actually do influence price action. For example, if a stock is approaching $100, a significant psychological milestone, you might see a few things happen. Buyers who got in at say $80 or $90 might be targeting $100 as their exit point to take profits. This creates selling pressure as the price nears $100. Simultaneously, short sellers might see $100 as an overvaluation point or a natural place for the rally to stall, so they might initiate short positions there. All this concentrated activity around that round number can cause the price to hesitate, consolidate, or even reverse. These psychological levels often get a lot of media attention too. This heightened awareness draws even more eyes to these levels, further reinforcing their potential impact. Alright, let's shift gears a bit and talk about a dynamic way to find support and resistance moving averages. Now, if horizontal support and resistance lines are like fixed floors and ceilings, moving averages are more like flexible, flowing rivers that the price often respects. A moving average, or MA, simply calculates the average price of a stock over a specific number of periods, like days, hours, or even minutes, and plots it as a line on your chart. It smooths out the day-to-day price choppiness and helps you see the underlying trend more clearly. Think of it like this. If you track your daily steps, some days you walk a lot, some days very little. It's erratic. But if you take a 30-day moving average of your steps, you get a much smoother line showing your general activity trend. Stock prices are the same. Moving averages help us cut through the noise. And here's the cool part. These smooth lines themselves can act as dynamic support in an uptrend and dynamic resistance in a downtrend. The price will often pull back to a moving average, touch it, and then resume its trend. There are many different moving averages traders use, but some of the most popular ones are the 20-period, 50-period, 100-period, and the 200-period moving averages. Shorter-term moving averages, like the 20-period, react more quickly to price changes and are often used by short-term traders. Longer-term moving averages, like the 200-period, are slower to react but are considered more significant indicators of the long-term trend. Many traders will plot several moving averages on their chart to get a multifaceted view. So, how does this dynamic support and resistance work in practice? In a strong uptrend, you'll often see the price pull back to, say, the 50-day moving average, find support there, and then bounce higher. Buyers see this pullback to the moving average as a good opportunity to join the prevailing uptrend at a better price. Conversely, in a downtrend, the price might rally up to the 50-day moving average, hit it like a ceiling dynamic resistance, and then continue its move lower. Short sellers often watch these rallies to moving averages as potential entry points. It's really quite visual. Last but definitely not least, let's talk about trendlines. If horizontal support and resistance levels are about specific price points, and moving averages are about dynamic, flowing levels, then trendlines are about the direction and angle of support and resistance. Think of a mountain range. An uptrend line is like drawing a line connecting the successively higher valleys, troughs, as the mountains climb. A downtrend line is like connecting the successively lower peaks as the mountains descend. These lines help you visualize the prevailing trend and can act as diagonal support or resistance. Drawing an uptrend line is pretty simple. You need at least 2 reaction lows troughs on your chart, with the second low being higher than the first. You then draw a straight line connecting these lows and extend it out to the right. This line now represents a potential area of dynamic support. As the price continues to move higher, it may pull back to this rising trend line, find support, and then bounce off it to continue the uptrend. The more times the price touches and respects this trend line, the more valid and significant it becomes. Conversely, to draw a downtrend line, you need at least 2 reaction highs, peaks, with the second peak being lower than the first. You connect these highs with a straight line and extend it out to the right. This line now represents potential dynamic resistance. As the price continues to fall, it may rally back up to this falling trend line, encounter selling pressure, and then turn back down to resume the downtrend. Again, multiple touches make the trend line stronger and more reliable. Now, one of the criticisms of trendlines is that they can be a bit subjective. Where exactly do you draw the line? Do you connect the wicks of the candles or the bodies? My advice is to aim for the most touches possible without cutting through too many candle bodies. Consistency is key. If you choose to use wicks consistently. If you use bodies consistently. And critically, a trend line is generally considered more valid if it has at least 3 touch points. Alright guys, we have covered a ton of ground today. We've dived deep into the 5 pillars of support and resistance. Those crucial horizontal support levels acting as your market trampoline, the equally important resistance levels as the market's ceiling, those sneaky psychological levels playing mind games with round numbers, the dynamic guidance of moving averages, and finally, the directional power of trendlines. Understanding and applying these concepts isn't just an option if you're serious about trading, it's an absolute necessity. These tools help you read the market's intentions and make much more calculated decisions. So, what's next? Knowledge is only powerful when you apply it. I want you to go back to your charts, open them up and start identifying these levels. Practice drawing them. See how price has reacted to them in the past. The more you practice, the more intuitive this will become. Keep learning, keep growing, and I'm genuinely excited to see you succeed. I'll catch you in the next video.